Kenvue Inc. is currently trading at $16.42, up about 1.77% on the day. But that small green candle, that 28-cent move, is one of the most misleading figures on the entire market right now. Looking at that alone, you'd miss the entire story. The real action happened yesterday, a massive 17% spike on news that rocked the consumer goods sector. The expectation, the headline you read, is that Kimberly-Clark, the makers of Kleenex and Huggies, has agreed to acquire Kenvue in a colossal $48.7 billion cash and stock deal. The terms value Kenvue at $21.01 per share. So let's stop and think. The deal price is $21.01. The stock at this moment is $16.42. This isn't a small gap. This isn't a few pennies of arbitrage. That is a chasm of nearly $5 per share, a discount of over 22%. The immediate expectation for anyone opening their Robinhood app or SoFi Invest platform is that this is free gain. You buy at $16.42, wait for the deal to close, and collect $21.01. It seems like the simplest online investment of the year. The reality? That gap, that $4.50 chasm, is the market screaming a warning. It's a massive, flashing red light telling you this deal is loaded with risk. The market is pricing in a significant probability that this acquisition either fails entirely, gets repriced dramatically lower, or will take so long to close that the returns aren't worth the capital being tied up. What we are watching is not a straightforward investment, but a high-stakes bet on legal outcomes and shareholder patience. This is the kind of complex situation that basic investing sites don't prepare you for. This isn't buying Apple stock for its ecosystem or Tesla stock for its growth narrative. This is a messy, complicated arbitrage play. Let's dissect the recent movement because it tells the whole story. Yesterday, Kenvue stock exploded higher, but at the exact same time, shares of the acquirer, Kimberly-Clark, plummeted by over 12%. That is a brutal reaction. It tells you exactly what Kimberly-Clark's own shareholders think of this deal. They hate it. And why do they hate it? Because Kenvue, the spin-off from Johnson & Johnson, doesn't just come with brands like Tylenol and Band-Aid, it comes with a suitcase full of potentially catastrophic legal liabilities. We are talking about the mountain of litigation surrounding Tylenol's alleged links to autism and ADHD in children when used during pregnancy, not to mention the lingering talc-related lawsuits. Just last week, the Texas Attorney General filed a massive lawsuit against both Kenvue and J&J over Tylenol marketing. Kimberly-Clark shareholders are looking at this and seeing their own company, a stable dividend payer, willingly swallowing a multi-billion-dollar poison pill. And Kenvue's standalone business, the reason it was a target in the first place? The numbers are not good. Coinciding with the acquisition news, Kenvue reported its third quarter 2025 results. They were, to put it politely, weak. Net sales decreased 3.5%. More importantly, organic sales, the true measure of health, fell 4.4%. The company affirmed its bleak full-year outlook, expecting net sales to be down in the low single digits. This is not a thriving business. This is a struggling company with shrinking sales. So the reality for Kenvue before this buyout offer was a stock in serious trouble, a name that Fidelity Wealth Management advisors were likely trimming, not adding. The stock was drifting near its 52-week low of $14.02 for a reason. Kimberly-Clark is in effect buying a fixer-upper with a collapsing foundation. The trading we're seeing today at $16.42 is the cold, hard calculation of professional arbitrage desks, the ones using sophisticated interactive brokers' trading platforms. They are weighing the potential $4.50 upside against the downside. And what is the downside? If this deal breaks, Kenvue stock isn't a $16 stock. It's a $14 stock or a $12 stock or worse. It would instantly revert to trading on its own terrible fundamentals. The shrinking sales, the massive debt load it was saddled with during the J&J spinoff, and the full, crushing weight of the litigation. Suddenly, that 1.77% gain today looks less like a sign of strength and more like a nervous tremor on a tightrope. This is the kind of investment help you rarely get. The price itself is telling you the risk. So let's briefly rewind. What is Kenvue? It's the company born from the 2023 Johnson & Johnson separation, designed to be a pure-play consumer health giant. The portfolio is legendary. Tylenol, Listerine, Band-Aid, Neutrogena, Aveeno, Zyrtec. These are iconic, world-class brands. The expectation at the IPO was that by separating from J&J's pharma and medtech business, Kenvue could be a nimble, focused company, a dividend-paying stalwart, perfect for a Fidelity brokerage account or a batch of Fidelity ETFs focused on consumer staples. The reality was that J&J used the spinoff to offload its consumer-facing liabilities, specifically talc and Tylenol, onto Kenvue's new debt-heavy balance sheet. The IPO was less of a liberation and more of a strategic containment of a legal problem. Investors who bought in for safety and dividends have been punished, watching the stock fall from its post-IPO highs near $25 all the way to $14. Now we shift to the future, and it is entirely about this deal. The bull case, the expectation, is that the deal closes as planned in the second half of 2026. The bulls believe the $1.9 billion in cost synergies Kimberly-Clark is targeting are achievable. They believe the legal risk is quantifiable, and that KMB, with its larger balance sheet, can settle the cases for a manageable sum that's already priced into the discount. For them, buying in an individual brokerage account at $16.42 is a smart, risk-adjusted bet. They're looking at the $3.50 in cash and the 0.14625 shares of KMB as a solid payout. Even if they have to wait a year or more, they see Fidelity Investments and other large funds eventually coming around. The bear case, the reality, is far darker. The bears see that 12% drop in KMB's stock as a sign of a shareholder revolt. They believe there's a real chance KMB shareholders will vote this deal down. Why would they approve diluting their own shares to buy a shrinking company with uncapped legal exposure? Alternatively, they see the litigation as a material adverse change. They predict that as the legal news gets worse over the next year, Kimberly-Clark will use it as leverage to either walk away, paying a breakup fee, or, more likely, force Kenvue to renegotiate the price far lower. Comment below if you think the Kimberly-Clark deal will close at $21 or if Kenvue shareholders are going to be left holding the bag. The bears are adamant that if this deal fails, Kenvue stock has no support. It's not a value play, it's a value trap. It's a classic example of why self-investing can be so difficult when headlines obscure the fundamentals. This isn't a simple buy on the Robinhood app, it's a bet on corporate lawyers and deal mechanics. So as we look at Kenvue at $16.42, the picture is now clear. The expectation was that Kenvue, with its stable of household brands, would be a safe haven investment, a cornerstone for a Schwab Intelligent Portfolios or a bedrock for Fidelity IRAs. The reality since its IPO has been one of litigation, debt, and declining performance. The new expectation, as of yesterday, is a $21.01 buyout. But the new reality, reflected in today's price, is that the market has profound doubts. That $4.50 gap isn't an opportunity. It's a risk premium. It's the price of uncertainty. Kenvue's fate is no longer in its own hands. It's in the hands of Kimberly-Clark's angry shareholders and the lawyers squaring off in courtrooms over Tylenol. This isn't a simple stock. It's a legal drama playing out in real time on the stock chart.